We benefit from volatility. Our rhythm is opposite most of the market's rhythm. We buy things when the market's down, we sell things when the market's up. For me, it's natural, but for a lot of people, it's fighting human nature. But when you find out about it, it's like being let in on this little secret.
Seth Klarman is a highly respected value investor managing over $30 billion in assets. But despite his success and influence in the investment world, he maintains a relatively low public profile. He does not give a lot of interviews or lectures. But I watched everything I could find on the internet and distilled all the most important remarks, ideas, and tips into this one video. So let's start with Seth Klarman explaining what are the fundamentals of value investing.
I think Warren captured the idea himself in his 1964 article, The Super Investors of Graham and Doddsville.
Right.
And in it, he talks about value investing is like an inoculation. You either get it right away or you never get it. And I think it's just true. I actually think there's a gene for this stuff, whether it's a value investing gene or contrarian gene. I think that everybody appreciates a bargain, but when the market's going down, most people overreact and get scared. My stock is going down, what am I going to do? So if you're buying a sweater and it goes on sale from $400 to $150, you get excited when you get to the store. But if you have a stock or you bought the sweater at $400, maybe you're not so happy. So I think for me, it's natural, but for a lot of people, it's fighting human nature. But it is true, it's what Warren Buffett said. When you find out about it, it's like being let in on this little secret. And so if you can remember that stocks aren't pieces of paper that gyrate all the time, that stocks are fractional interest in businesses, it all makes sense. So it's almost like you have to slow the game down, like they talk about baseball speeding up on you. You need to slow it down. I can buy this thing for a huge fraction of what it's worth. What am I worried about if it goes down a little bit more?
Okay, but so what's the gift here, knowing what it's worth?
I think that the analysis is actually the easy part. When I speak to business school students, I tell them investing is the intersection of economics and psychology. The economics, the valuation of a business is not that hard. The psychology, how much do you buy? Do you buy it at this price? Do you wait for a lower price? What do you do when it looks like the world might end? Those things are harder, and knowing whether you stand there, buy more, or something legitimately has gone wrong and you need to sell, those are harder things. And that you learn over with experience. You learn by having the right psychological makeup in the first place.
Oh, well, stop. What's the right psychological makeup that you have?
So
patience would be one.
Willing
to sit on cash would be another.
Value investors have to be patient and disciplined. But what I really think is, you need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow up is because of leverage. And then you need to balance arrogance and humility. And I'll explain what I mean. When you buy anything, it's an arrogant act. You're saying, the markets are gyrating and somebody wants to sell this to me and I know more than everybody else, so I'm going to stand here and buy it. I'm going to pay an eighth more than the next guy wants to pay and buy it. That's arrogant. And you need the humility to say, but I might be wrong. And you have to do that on everything.
I really like the idea that to be a value investor, you have to be a little bit different from the majority. You have to think and feel in a different way. You have to be a contrarian. I really believe it is the most essential part of all of this. Not that long ago, I talked with one of my really intelligent and successful friends and heard him say things like, I sold my stocks because everything is going down, so I just want to wait it out. I can't lose any more money. But in my head, I'm thinking, if you wouldn't sell, you would not have lost anything. And if everybody is selling, then it may be a perfect opportunity to buy, because all the companies are now cheaper, just like things in the supermarket when they go on sale. This is a huge difference, not in intelligence, knowledge, or abilities, but in character and a way of looking at the world. Seth Klarman also mentions patience as one of the most important virtues for a value investor, and that touches on another important thing that has to do with the time horizon we use.
I have justified it to myself, and sometimes I need to justify it to myself, that what I'm trying to do is a marathon and not a sprint, that investing lends itself to sprinting, that you get measured frequently. A lot of my competitors measure their performance every single day. I sort of laugh about that. In fact, they have it real time. You can look at your computer at any moment and say, we're up 32 basis points today. What I don't like about that is, what are you going to do with that information? That we're down 40 basis points already this morning. Let's work harder. Let's do something. That's not what investing is. So remembering that it's a marathon and not a sprint, and maintaining that focus on what you're really trying to do and what's noise is incredibly important. I do think recharging your batteries, getting a healthy distance from what you're doing every so often, and also being a whole person, that nobody wants a leader to be a workaholic drone, that you know, and in a human life that you have to find a balance and multiple interests, and to avoid burning out. What kind of leader would you be if you burned out after 5 or 10 years? So I think developing all of yourself with philanthropic interests and personal interests and putting family first are all critical aspects for a leader. And by the way, those are examples that you set for other people, so that everyone in our firm is comfortable working out in the company gym during the day if they feel like it, is happy to leave work to go to see their kids in a school performance, and is making sure they take their vacation time too. And I'm delighted that if I've set any example in that regard, that people have followed it.
This is some great advice, not only for investors, but for all professions. Burnout is a real thing. It can touch any one of us. If you are focused only on one thing, if you are obsessing about something, sooner or later, it is going to be too much for you to handle. So finding a balance in life, slowing down every now and again, setting some time aside for your loved ones and your hobbies is actually crucial to allow us to keep a long-term perspective and to be consistent in it, to be able to run this marathon that is investing. Also, it is not only Klarman that emphasizes the importance of not checking your portfolio results on a daily basis. You can find similar views from Nick Sleep, Guy Spear, or Warren Buffett himself. Obsessing over daily results can influence our decisions, make us want to react to short-term events, and mix useful information with noise. And treating investing as a marathon, not a sprint, moves us to the next question concerning timing the market.
Can you talk to us about your philosophy of timing? Is there no philosophy of timing? Because you're looking at value, and that you understand value, and essentially the big decision for you is the buy decision more than the sell decision.
Buying's easier, selling's hard
Right.
to know when to get out. There's no timing element. You can never tell how big a bargain you might get offered tomorrow. If somebody comes along and wants to sell you $1 for 50 cents,
Right.
you can never know if they'll want to sell to you at 40 cents tomorrow. So you need to buy it and leave a little room to buy more, and maybe someday spend your last dollar and buy the bargain, and maybe it goes down before it goes up. So you always are checking and rechecking your work. The critical thing, the thing that would cause you to lose your confidence when you're doing that, would be if you realized $1 wasn't $1. You thought it was worth $1, but Greece failed, or the euro fell or collapsed, and all of a sudden your dollar is only 30 cents, and now what you thought was a bargain is overvalued. So that's the dilemma. It's not so much figuring out what it's worth today, it's making sure it'll still be worth that same thing, or approximately that same amount tomorrow.
When you invest for a few years, you realize that Klarman is right. Selling is much harder than buying. You get emotionally attached to an investment, and the fear of missing out on future results is mixed with a fear of not realizing the gains and losing this opportunity. So it is like a double FOMO effect, the fear of missing out. And I just wanted to add to what Klarman said about buying a stock that then goes down in price, a very nice saying by Howard Marks. In investing, being too early is indistinguishable from being wrong. So again, we have to feel okay with being a contrarian. We have to be okay with hearing from people around us that we made a mistake by buying a cheap company just because it is now even cheaper. That is not easy. But like Warren Buffett said, investing is simple, but not easy. So if it is so complicated, if you have to understand the businesses, decide when to buy, when to sell, what price is right, and so on, maybe the best way would be to invest in a broad market ETF.
You know, Warren Buffett's often talked about index funds. Becky was mentioning index funds to you before, which have changed the business. I think that's actually what's made them so much more efficient to a large degree. But do you also subscribe to the philosophy that if you can invest with Seth Klarman, that you should actually be investing in index funds, and that's the safer and best path?
You know, the argument for index funds is that you're going to have low transaction costs near zero, and you're going to have exposure to the market. You're not going to underperform the market, but neither will you outperform the market. I think for the average person out there who isn't terribly sophisticated and is able to take a long-term view, I don't see anything wrong with index funds. But I think one of the critical things about the long-term return from investing is that it depends on the entry price. So if you enter when the market's very expensive at a high valuation, you may be disappointed because you might match the index, but the index may not do very well from there. So the other thing is you don't want to go into index funds, experience a bad market, and then bail out. That's what investors tend to do.
Right.
They get in at the wrong time and they get out at the wrong time. And so investors who go into index funds should go in with the idea that they're going to stay through thick and thin.
So even if you would invest in index funds, you also have to have the same mindset that is needed for a value investor. You have to be patient, you have to have a long-term view, and you have to take into account the price, because it is not only about what you buy, but what you pay for it. And finally, you have to be a contrarian. You have to stay in the market even if everything is going down and all your friends are selling and telling you to save your money and get out as well. So I will leave you with some more thoughts from Seth Klarman about being a contrarian and about taking advantage of the market volatility.
We benefit from volatility.
And distressed debt and everything else.
We provide liquidity when people want to sell things in a hurry. Presumably, you know, it's a transaction between consenting adults. When somebody owns a bond that was AAA and now is CCC, they want to sell, they want liquidity. We sort of our rhythm is opposite most of the market's rhythm. We buy things when the market's down, we sell things when the market's up. Do I root for bad times? Of course not. I love our country.
I didn't mean it that way, bad times, but
is it frustrating when the market goes straight up and up and up as it did from 82 to 87? It was frustrating, and I worry because just at those times, it's when the little guy gets sucked in and the little guy finds it irresistible when the market's going higher and higher. The little guy gets pulled in by stories from their neighbor, stories at the cocktail party, and they hear about how much money people are making in the market. Charlie, you probably know this, but the return from all mutual funds in the 1990s was 600 basis points higher than the average return from the investors in those funds during the same period. And that's because they get in at the wrong time and out at the wrong time. So that's painful to me.
So what is your lesson?
That's why I wrote the book, to try to educate the average person. but only like a few hundred of them read the books.